Hey guys, welcome back. My name is Casey Kepley. If you're watching this for the first time, thank you for checking out my channel. Let me just go ahead and tell you kind of what my channel is about before I get started here on this next financial tool for investing. Basically, I've experienced in the last 6 years my own trials and tribulations with investing. Some of that was through just researching and then putting my money on the table. So I wanted to cover, I wanted to help people out and give them an idea of, what it takes to invest, kind of how to go about it the right way. So that's what I'm doing here, is trying to help people out with, certain tools that you can use for the long-term approach and also for the short-term approach. So again, thank you for checking me out. If you're somebody who was just coming back, I made a video last week, like December 8th, 2015. Today's the 15th of December, and that video covered the long-term approach to investing, which would cover your security bucket. It breaks down the different steps, so step 1, 2, 3, 4, on exactly what to do for the long-term approach to investing. Now, if you haven't checked that video out, go back and check that out, and then come back to this one, because today I'm not going to cover that. I'm going to cover a financial tool that you can use in your security bucket. Excuse me, and I'm going to just touch on the different types of CDs you can use. It's a certificate of deposit, if you're not familiar with what a CD is. So this video is just going to be dedicated to CDs, and I'm going to tell you exactly what kind of contracts are out there. Just basically things that you can look into before you invest in a CD. Now, you're probably asking, if you know what a CD is, certificate of deposit. If you don't, basically what you're doing is you're taking your money, you're going to a major financial institution like Wells Fargo, Bank of America, Citibank, Citigroup, U.S. Bank, Commerce Bank. The list goes on. Almost every single major banking institution has this tool available to you. And it's a very low-risk investment, okay? And you're gaining a certain amount of money, or gaining an upside, part of the upside to, returns on the S&P 500 without the downside. So you're not really losing your principal, which is the amount of money that you're going to use to invest in a CD. So what you're doing is, in a nutshell, you're taking your money and you're letting the bank borrow it, and then in return they give you a certain amount of money back over a certain amount of time. All right. So we've got that out of the way. It's a certificate of deposit. It can be purchased through, again, the major banking institutions. And you might be asking what types there are in CDs. There's just your regular old-fashioned CD that you can get, which is mostly what you're going to find if you go out on Google and do a search for certificates of deposit. You'll find the regular old-fashioned rates for just plain old certificate of deposit. Okay? These, however, have a lower rate of return. All right? And some of that is based off of interest rates. Okay? Let me give you an example real quick. Janet Yellen supposedly they're really amping up and doing a lot of hype around, or talking a lot of hype around the raising the interest rates here probably in the next week. Okay? And if they do that, certain things are going to go up. In other words, like loans on mortgages, cars, stuff like that. Those things might go up when it comes to the interest rates that you're paying on those. Okay, now if you're invested in a CD or a certificate of deposit, you're letting the banks borrow your money. So if those interest rates go up, there is a possibility, and this isn't guaranteed by any means, because nothing is in financial markets, and especially when it comes to investing, there is no guarantee like 100%, but the chances of, let's say, the rate of return on that CD going up after they raise interest rates for people borrowing money from the banks, there's that possibility that the interest rate or the rate of return on your CD that you're invested in could possibly go up. So just something to consider, because CDs, certificates of deposit, are they do good in any environment. They do better though when the interest rates are being raised. So just something to consider there. That's for regular CDs. Also, there is something called a market-linked CD, and this kind of CD, it'll offer a higher rate of return for you. I haven't done a whole lot of research on them yet because they're kind of hard to find. The only place that I know of so far, or that I've seen, just going out on Google, typing in, a linked market CD, I found Goldman Sachs has some of those, and the rate of return on them can vary between like 1 and 6%. Okay, so that's probably going to be a lot better for you than a regular CD if you're looking for a higher rate of return. And when it's linked to the market, what I mean is, the S&P 500, for instance, normally it averages about an 8.9 to about a 9.8% return, and that's annually. Okay, so that's the entire market as a whole, which will, on average, give you about a 9.8% return max. Okay, on an annual basis. That's for that total S&P 500. You can find CDs though that are linked to the market. So basically, what they'll do is they'll cap and not cap, but they're basically gonna go out there and grab hold of a certain percentage of the returns that the market will have throughout a year. So let me give you an example real quick. I said that the S&P 500 has about a 9.8% annual return. Of that 9.8%, a linked market CD might cap you out a part of that return, so it might give you about 5 to 6% of that 9.8. Okay, without the downside though. That's without the downside, because all you're doing again is letting the banks borrow your money so they can lend it out to other people. All right, and that's the power of certificates of deposit. Because again, I talked about asymmetrical risk reward in the previous video that I did on the long-term approach to investing. Again, check it out if you haven't checked it out yet. But the asymmetrical risk reward for a CD is the risk is really low. Okay, and the rewards, they're not extremely high, but you're pretty much guaranteed to get a return on these investments. Now, the risk that I was talking about with CDs and being low is true. It's low risk. However, something to consider before investing in a CD. When you give your money to a bank, okay, there's something called FDIC. It's a federally deposited insurance certificate. I don't know. I'll have to go back and look up exactly what FDIC stands for. I can't remember right offhand. But basically what it means is your money is going to be insured. So if something happens to the banks and they close their doors, you're insured up to $250,000 through the FDIC. Okay, so it's federally insured, basically, is what it's saying. These are FDIC insured, most of them. There are some that aren't, though. Okay, like I went in and looked at market-linked CDs. Some of those are not insured through the FDIC. Now, for me, that's a risk, because guess what happens if that bank goes bankrupt? They go out of business. And can that happen? Yeah, it can, because if you go back to 2008 and you just do a little research on what happened to Lehman Brothers, you'll find out they went out of business overnight. Okay, they went belly up. There was a lot of people that had their money tied up in CDs, and guess what happened? They lost their money. I mean, the bank went bankrupt, and therefore it wasn't insured. I mean, some of them might have been, but a majority of them didn't get their money back. So when I'm saying there's risk to CDs, that's the kind of risk I'm talking about. Now, it's very, very low risk because the chances of that happening again are very, very, they're very low. Can it happen? Yeah, it can happen again. And I'm hoping to God it doesn't, but it can. So it's something that you need to consider when you're investing in CDs. Just go out and do your research, And I'd recommend going with major banking institutions so that you're not having to worry about the bank going under, nobody, being there to try to prop it up. The reason why I say that is because, Bank of America, some of these other major banking institutions, if you go back and research 2008, they were propped up, okay? If you got people bailing out the banks and there's this too big to fail, guess what? What do you think is going to happen next time the banks experience the same thing? They're going to do the same thing. They're going to bail them out. I mean, they just keep doing the same stuff over and over and over. It's so predictable what they're doing. And when I say they, I'm talking about the federal government. So predictable what they're doing right now. So if you think Bank of America or Wells Fargo, maybe Goldman Sachs, if you think any of these banks are going to completely disappear and vanish off the face of the earth, the chances of that happening are very, 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 very slim. Next to zero. So, something to consider. Go with a bank like that. That's what I would do. I mean, and that's basically what I'm going to do investing in CDs right now. Because my other video I told you I was going to flip CDs. So I'm looking at banking institutions that are that kind of size. The real big ones. Because you don't really have to worry about them going out of business. Somebody's going to be there to prop them up. Let's see here. Usually these CDs will come in contracts. Okay, so you can when you lend your money to the banks so that they can borrow them, they're going to borrow it for a certain amount of time. All right, so there's a maturity date. They call it a maturity date on your certificate of deposit. Now these maturity dates are contracts, and basically they can come in a 3-month contract, a 6-month contract, a 1-year contract, 2-year contract, 3-year contract, 4-year contract, 5-year contract. Some of them will go higher than that. You just got to go out there and do some of the research and find out which ones, offer what when it comes to the longevity and maturity dates of some of these CDs. But basically, what it means is you're giving your money over to them, and you do a 3-month contract, you're locked in for 3 months. All right, so you got to wait 3 months till the maturity date, and then once it matures, then you can withdraw your money. All right, now this is also part of the risk with CDs. Let's say you want to withdraw that money early. It might vary depending on the banking institution, but you're looking at about a 20% fine. So if you put $1,000 into a CD, you withdraw it early because you ran into an emergency, you can expect the banks to probably take, whatever bank you're with, again it might vary, but they'll probably take about 20% of that $1,000. So you lost, 20% of $1,000 is $200.